So I'm here to fight this myth tonight. Just tell you why I think these VA loan buyers get a bad rap, or because these real estate agents sometimes might think that the loans that they're getting are trickier to deal with. I think it's misguided. I'm going to run through several reasons as to why, and just give you some other reasons as to what you probably don't even know about that actually makes these VA loans way easier than other conventional conforming loans. So start at the top. A big pushback I get on these from agents when they're deciding on what buyer's loan to accept is that there's an appraisal required. Well, that's true. I mean, it's rare that a conventional conforming loan would even get its appraisal waived by Fannie Mae and Freddie Mac in the first place. Usually the down payment has to be at least 20%. FHA requires appraisals too, okay? I mean, this is common on government loans. Something that might be an annoyance to sellers is the stair railings requirement. So basically, if there's a stairway, it has to have a railing for the veteran to make sure that they don't get hurt or, just avoid falls or injuries. I'm not totally sure why this is a thing, but I would guess that if it's a veteran's home, and even if they're not injured when they buy it, but they go off to war, get injured, come back, they could need that for safety. But so if you didn't have a railing on the stairway, you would have to get that done before you sell your home. Now, there's always items that come up on the home inspection that require the seller to think for a minute and say, yeah, I really should get this fixed for the buyer before I sell it to them, either because it's a lender required repair or they just think it would be fair between the two agents negotiating it out. Something else, a reason why I think these VA loans get some hate is the pest inspection. Usually have to have a pest inspection done. They're not that expensive though, and it's just a guy coming to look at the house before closing for an hour or so. A big one here is some agents think that if they're going to get an offer from a VA loan, they think it's automatically going to be a zero down loan. That doesn't have to be the case. I get vets coming all the time that bring down payments. They still just want to keep their benefit and do the VA loan because the financing is going to be, in a lot of scenarios, just more advantageous to them, make more financial sense than a conventional or another loan would make. Vets have great incomes, by the way. I mean, they have lots of different sources of income. They're very well taken care of, mostly by the VA. I mean, you should see some of their income statements that I see when I bring them in for pre-quals. They look really good. But just because buyers will do zero down doesn't mean that they don't have reserves. And sometimes these agents will think that that's the case. They think that because they're making a zero down loan, that if the appraisal comes in low, then they can't cover that gap or something, or it means that they think that they don't trust them to make it to closing. Well, a lot of times these buyers will have a big chunk of change, 40, 50K. After paying for the closing costs, they still just want to have money to themselves to update and upgrade and improve the house the way they want it, because nobody necessarily wants to buy a house and live in it the way the last owner did. They want to make, their own personalizations to it based on their preferences. Another thing here, debt to income ratios. Conventional approvals can allow the debt to income ratio to go up to 49.99%, and FHA can go up to 56.99%. That's assuming they don't have poor credit. That's based on what the algorithm at Fannie Mae, Freddie Mac are going to give us. Every scenario is different. I'm not saying every single buyer doing conventional and FHA are going to get a debt to income ratio up that high, but VA loans, as long as they don't have poor credit or have a tricky situation that maybe requires a manual underwrite, they're underwritten off more of a residual income basis than on a percentage ratio like conventional or FHA. So in other words, the VA underwriter is looking at this and saying, okay, well, after you receive your paycheck, after you get your 401k, your insurance, your tax deductions subtracted from your paycheck, and then you make all your monthly payments on your home, your credit card, student loans, car loans. This is how much money you now have left over after that every month. They look at it as a dollar figure. And $500 to $900 left over after every month can work. Depending on the loan. I mean, it depends. There's a chart that I'd have to go through for each loan to look at it. Basically, the VA is going to tell me after I submit the loan for automatic underwriting how much that amount is. But I have seen debt to income ratios on a VA loan. Now, this is way long ago, and I'm not saying this is going to be the case for you, but I've seen an approval of up to 72% debt to income ratio, believe it or not. So it's just a different ball game here when buyers are going through underwriting. A really positive feature about these is that poor credit scores don't really impact the pricing as much as maybe a poor credit score on conventional or FHA. Now, that's my opinion. Every pricing scenario is different, but I think the VA loans are a little bit more lenient on maybe below average credit scores. There's no PMI here. No PMI on VA loans to drive up the debt to income ratio. No maximum closing cost subsidy from the sellers, okay? Some people think that the maximum seller subsidy they can give a buyer on one of these is 4%, but that's only for the prepaids and debt paydowns from the seller. So there's really no max on the amount of closing credits that the seller can give somebody. So it makes it very workable for some buyers there if they're still, cash strapped on savings. There's no 10 plus acreage limit. A lot of vets want to buy out in the hillsides, rural areas, further outside of town, ain't buying suburban homes all the time. So if they want to buy a house that's almost closer to a farm, I've seen buyers buy 55 acre plots with a VA loan. They can do these. Look, I do these all the time in the DC area. It's a huge military area. You've got all the way up and down 95, especially in Virginia, starting in Fredericksburg, Stafford, Woodbridge, all the way up into Alexandria, Arlington. We have these huge pool of VA buyers, and agents up there, they're much more well versed to it, and they're not afraid of it because they've seen them all the time, and they know that they're not that big a deal. But I've seen people in Texas or other areas, or just people with other trains of thought, be more afraid of them. They think it's going to be tougher to get their buyers in with that. And I think that they think that there's just some mystery to them, or that they're more difficult. I don't believe that at all for one second. The steel railings do have to be done before closing. I think that's like the biggest barrier. But, like I said, we see all these contracts all the time that require fixes to be done before closing. And you really just got to have a contractor. So that's like the biggest part there. But guys, I hope you enjoyed that. I got several other VA related videos here going over the funding fee and streamline EARLs and several others that I think you would be happy to check out here. Keep scrolling through. I'm sure you can find some other great stuff on this channel as well. And I'll see you on the next video. Thank you.